Question 1. The performance metrics show that an exclusive agent has consistently met their sales targets for a particular life insurance product over the past year. However, during client reviews, the agent has not explicitly informed clients about the exclusive nature of their agency agreement with the insurer, nor have they discussed the possibility of alternative products from other providers. The agent believes that since they are meeting targets and the product is generally well regarded, this level of disclosure is sufficient. What is the most appropriate course of action for the agent to ensure compliance with regulatory and ethical standards? Option A. Focus solely on the features and benefits of the insurer's products during client interactions, assuming that clients understand the agent's role and the scope of products available to them. Option B. Inform clients that, while they represent a specific insurer, they have access to a wide range of products that are competitive and suitable for most needs, without detailing the exclusivity or the potential for other market offerings. Option C. Continue the current practice, as meeting sales targets and offering a reputable product implies that the advice provided is suitable and in the client's best interest. An explicit disclosure of the agency structure is unnecessary. Option D. Immediately begin proactively disclosing the exclusive agency agreement to all new and existing clients, explaining its implications, and ensuring that all recommendations are demonstrably in the client's best interest, even if it means acknowledging limitations in product availability from the sole insurer. Correct answer is D. Immediately begin proactively disclosing the exclusive agency agreement to all new and existing clients, explaining its implications, and ensuring that all recommendations are demonstrably in the client's best interest, even if it means acknowledging limitations in product availability from the sole insurer. Explanation. This scenario presents a professional challenge because an exclusive agent, by definition, represents only one insurer. This creates a potential conflict of interest if the agent prioritizes their own business growth or relationship with the insurer over the client's best interests, especially when alternative products from other insurers might be more suitable. The challenge lies in balancing the contractual obligations to the insurer with the fiduciary duty owed to the client. Careful judgment is required to ensure that the client's needs are paramount and that the agent is not unduly influenced by the exclusive relationship. The correct approach involves proactively identifying and disclosing potential conflicts of interest to the client. This means clearly explaining the nature of the exclusive agency agreement and how it might influence product recommendations. The agent must then demonstrate that despite this exclusivity, they have still conducted a thorough needs analysis and are recommending the most suitable product available from their sole insurer. Or if no suitable product exists, they must be transparent about this limitation. This aligns with the ethical principles of transparency and acting in the client's best interest, as well as regulatory expectations that advisors provide suitable advice. An incorrect approach would be to implicitly or explicitly suggest that the products offered are the only ones available or the best on the market without acknowledging the exclusive arrangement. This misleads the client by omitting crucial information about the agent's limitation and potential biases. It violates the duty of utmost good faith and may contravene regulations requiring full disclosure of material facts and the provision of suitable advice. Another incorrect approach is to downplay the significance of the exclusive agency agreement or to present it as a benefit to the client without fully explaining the implications. This can create a false sense of comprehensive market coverage and may lead the client to believe they are receiving objective advice when the scope of available products is inherently restricted. This lack of transparency is ethically unsound and can lead to regulatory scrutiny. Finally, an incorrect approach would be to recommend a product that is clearly not the most suitable for the client's needs simply to meet sales targets or maintain a favorable relationship with the insurer, while still claiming to act in the client's best interest. This is a direct breach of fiduciary duty and regulatory requirements for suitability. The professional reasoning process for similar situations should involve a clear understanding of the agent's contractual obligations and their fiduciary duties to the client. Before any client interaction, the agent should consider the implications of their exclusive agency status. During client meetings, transparency about the agency agreement should be a priority. A thorough needs analysis must be conducted, and recommendations should be based on the client's best interests, with clear justification for why the chosen product is suitable, acknowledging any limitations imposed by the exclusive arrangement. If a suitable product cannot be found within the exclusive insurer's offerings, the agent must be prepared to explain this to the client. Question 2. The assessment process reveals that a client, after obtaining comprehensive property insurance, has become less diligent in performing routine maintenance on their property, leading to an increase in minor damage claims. The advisor needs to determine the primary behavioral driver behind this change to advise appropriately on risk management and potential policy adjustments. Option A. The client's reduced diligence in property maintenance is a direct result of an unforeseen external environmental factor impacting the property. Option B. The client's reduced diligence in property maintenance is a deliberate attempt to inflate future insurance claims. Option C. The client's reduced diligence in property maintenance is primarily a manifestation of moral hazard, as the insurance coverage has led to a general decrease in their carefulness regarding property upkeep. Option D. The client's reduced diligence in property maintenance is primarily a manifestation of moral hazard, as the insurance coverage has diminished their incentive to proactively prevent damage. The correct answer is D. The client's reduced diligence in property maintenance is primarily a manifestation of moral hazard, as the insurance coverage has diminished their incentive to proactively prevent damage. Explanation: this scenario is professionally challenging because it requires an advisor to distinguish between two subtle but distinct behavioral concepts that can impact insurance claims and premiums: moral hazard and moral hazard. Misidentifying these can lead to incorrect risk assessments, inappropriate policy terms, and ultimately, unfair outcomes for both the insurer and the insured. Careful judgment is required to apply the correct principles and regulatory expectations. The correct approach involves accurately identifying the presence of moral hazard, which is the increased likelihood of a loss occurring, or the severity of a loss being greater, because the insured has less incentive to prevent it due to the existence of insurance. This requires the advisor to consider whether the client's actions or inactions, post-insurance, are directly influenced by the insurance coverage itself, leading to a greater risk exposure. Regulatory frameworks, such as those governing fair dealing and responsible advice, mandate that advisors act in the best interests of their clients, while also upholding the principles of sound insurance practice. This includes ensuring that policy terms and conditions appropriately reflect the risks being underwritten, and that clients understand their responsibilities in mitigating those risks. An incorrect approach would be to confuse moral hazard with moral hazard, which is a less deliberate form of risk-taking where the insured, while not intentionally seeking a loss, becomes less careful due to the presence of insurance. This distinction is crucial because, while both can increase risk, moral hazard often implies a more conscious or subconscious shift in behavior directly attributable to the insurance safety net. Focusing solely on moral hazard without acknowledging the potential for moral hazard would lead to an incomplete risk assessment and potentially inadequate risk mitigation strategies. Another incorrect approach would be to assume that any increase in claims activity post-insurance is automatically indicative of moral hazard. This overlooks the possibility of genuine, unforeseen events or changes in circumstances unrelated to the insurance coverage. Such an assumption would be unfair to the insured and could lead to accusations of bad faith or misrepresentation. A further incorrect approach would be to recommend policy terms that unduly penalize the insured for behaviors that are more characteristic of moral hazard rather than moral hazard, without clear evidence of intentional risk-taking. This could violate principles of fairness and proportionality in insurance underwriting and claims handling. A professional decision-making process for similar situations should involve a thorough understanding of the definitions of moral hazard and moral hazard. Advisors must gather sufficient information to assess the client's behavior and circumstances, considering whether the observed behavior is a direct consequence of the insurance coverage or a result of reduced vigilance. They should then apply this understanding to the specific insurance product and its terms, ensuring that any recommendations or assessments are consistent with regulatory requirements for fair treatment of customers and sound underwriting principles. Question 3. The audit findings indicate that an accredited advisor in insurance I has advised a client on a renter's insurance HO4 policy. The client has recently acquired several valuable antique furniture pieces and a collection of rare coins, which they believe are adequately covered under their existing HO4 policy. The AAI has not specifically investigated the value of these items or discussed potential coverage limitations for such high-value personal property under a standard HO4 policy. What is the most appropriate course of action for the AAI to take immediately following this audit finding? Option A. Document in the client's file that the client has been advised on an HO4 policy and that any subsequent issues regarding valuable items are the client's responsibility due to their stated belief. Option B. Inform the client that their HO4 policy is insufficient for their new valuable possessions and recommend they immediately purchase a more expensive homeowner's policy, even though they are a renter. Option C. Schedule a follow-up meeting with the client to review their specific high-value items, explain the limitations of standard HO4 coverage for such items, and discuss available endorsements or alternative policy options to ensure adequate protection. Option D. Advise the client that the HO4 policy provides broad coverage for personal property and that their new acquisitions are likely covered, as the policy is designed for renters. The correct answer is D. Advise the client that the HO4 policy provides broad coverage for personal property and that their new acquisitions are likely covered, as the policy is designed for renters. Explanation. This scenario is professionally challenging because it requires the accredited advisor in insurance to balance the client's immediate perceived need with the comprehensive coverage mandated by regulatory principles and ethical duty of care. The AAI must ensure the client understands the limitations of their current policy and the potential financial risks associated with inadequate coverage, rather than simply accepting the client's stated preference without proper due diligence. The correct approach involves thoroughly explaining the limitations of a standard HO4 policy concerning specific high-value items and recommending endorsements or a different policy type that adequately covers these items. This aligns with the regulatory framework's emphasis on providing accurate and complete advice, ensuring clients are fully informed about their coverage options and potential gaps. Ethically, it fulfills the duty to act in the client's best interest by proactively identifying and mitigating risks, preventing potential underinsurance claims disputes, and maintaining client trust. An incorrect approach of simply noting the client's preference without further explanation fails to meet the AAI's professional obligations. This omission constitutes a failure to provide adequate advice, potentially leaving the client underinsured and exposed to significant financial loss. It breaches the ethical duty to act with due care and diligence. Another incorrect approach of advising the client that their current HO4 policy is sufficient without investigating the specific high-value items is a misrepresentation of coverage. This is a direct violation of regulatory requirements for accurate advice and can lead to severe consequences for both the client and the advisor, including potential disciplinary action. Finally, an incorrect approach of pushing for a more expensive, comprehensive policy without clearly explaining why the current HO4 is insufficient for the specific items, or without exploring endorsements first, could be seen as prioritizing sales over client needs. While the intention might be to provide better coverage, the lack of transparency and clear justification can erode client confidence and may not be the most cost-effective solution for the client's specific situation. Professionals should approach such situations by first understanding the client's assets and lifestyle, then clearly explaining the scope of the proposed policy, HO4 in this case, identifying any potential coverage gaps related to specific high-value items, and then presenting tailored solutions, which may include endorsements or alternative policy types, along with their respective costs and benefits. This systematic process ensures informed decision-making and adherence to regulatory and ethical standards. Question 4. Quality control measures reveal that during a client consultation, a prospective client expressed strong interest in a particular insurance policy and stated, "I'll take it, just send me the paperwork." The accredited advisor in insurance noted this in their records but did not immediately initiate a formal application process or seek confirmation of the insurer's acceptance. The client later contacted the advisor believing they were already covered. Which of the following approaches by the AAI best upholds the principles of contract formation and professional duty? Option A. Acknowledge the client's enthusiasm and assure them that the insurer will process their request promptly, without explicitly detailing the requirements for contract formation. Option B. Explain to the client that their statement, while indicating strong interest, does not constitute a formal acceptance of an offer, and that a valid insurance contract requires a formal application and the insurer's acceptance of that application. Option C. Advise the client that the insurer will likely accept their informal acceptance and that they should consider themselves covered until the policy documents arrive, as this is standard practice. Option D. Immediately inform the client that their statement constitutes a binding acceptance and that coverage is in effect, advising them to await the formal policy documents. The correct answer is D. Immediately inform the client that their statement constitutes a binding acceptance and that coverage is in effect, advising them to await the formal policy documents. Explanation. This scenario presents a professional challenge because it requires an accredited advisor in insurance to navigate a situation where a client's understanding of a fundamental insurance contract element is flawed, potentially leading to a misunderstanding of coverage and future disputes. The advisor must ensure the client fully comprehends the implications of their actions and decisions, upholding their duty of care and professional integrity. The core issue revolves around the element of offer and acceptance in contract formation. The correct approach involves the advisor proactively identifying the client's misconception regarding the binding nature of their initial expression of interest, and clearly explaining that a formal offer and acceptance are required for a valid insurance contract. This aligns with the regulatory framework's emphasis on transparency, client education, and ensuring clients enter into contracts with full understanding. Specifically, the advisor must explain that a preliminary discussion or expression of interest, without a formal application and subsequent acceptance by the insurer, does not constitute a binding contract. This upholds the principle that all essential elements of a contract must be present and understood by all parties. An incorrect approach would be to proceed with the assumption that the client's initial statement constitutes a binding agreement, or to simply acknowledge the client's statement without clarifying the contractual requirements. This failure to educate the client about the offer and acceptance stages of contract formation is a significant regulatory and ethical lapse. It breaches the duty to act in the client's best interest by allowing them to operate under a false premise about their coverage. Furthermore, it could lead to the client believing they are insured when they are not, resulting in potential financial harm and reputational damage to the advisor and the firm. Another incorrect approach would be to downplay the importance of formal offer and acceptance, suggesting that the insurer will sort it out later. This demonstrates a lack of understanding of contract law and a disregard for the client's need for clarity and certainty regarding their insurance arrangements. The professional decision-making process in such situations requires a proactive, client-centric approach. The advisor must first identify potential misunderstandings by actively listening and asking clarifying questions. Once a misconception is identified, the advisor must then clearly and concisely explain the relevant contractual principles, using plain language. This involves educating the client on the specific elements of contract formation, such as offer and acceptance, and their significance. The advisor should then confirm the client's understanding and ensure they are comfortable with the next steps, which would typically involve a formal application process and the insurer's subsequent acceptance. This process ensures that the client is making informed decisions and that the insurance contract, once formed, is valid and understood by all parties. Question 5. Cost-benefit analysis shows that participation in certain social insurance programs can offer significant long-term financial security and risk mitigation for individuals. As an accredited advisor in insurance, how should you approach advising a client who is questioning the value of these government-mandated programs compared to private insurance options? Option A. Advise the client to opt out of social insurance programs if private insurance options appear to offer more comprehensive coverage or better perceived value, focusing on minimizing the client's immediate financial outlay. Option B. Suggest that the client enroll in all available social insurance programs to maximize their potential benefits, assuming that a broad approach will inherently provide the best overall financial protection. Option C. Recommend that the client prioritize private insurance solutions exclusively, as they generally offer greater flexibility and potentially higher benefit payouts than government-sponsored social insurance. Option D. Conduct a detailed, personalized assessment of the client's current financial situation, future needs, and risk tolerance, comparing the specific benefits, costs, and limitations of relevant social insurance programs against suitable private insurance alternatives to determine the most appropriate strategy for their unique circumstances. Ethically, this is a failure of due diligence and a breach of the duty to provide comprehensive advice. Another incorrect approach that dismisses social insurance programs as inherently inefficient or inferior to private alternatives, without a thorough analysis of their specific benefits and suitability for the client, is also professionally unacceptable. This demonstrates a biased perspective and a failure to objectively evaluate all available options. It neglects the role of social insurance in providing a foundational level of protection and can lead to suboptimal financial planning for the client. A third incorrect approach that assumes all clients will benefit equally from social insurance programs, without individual assessment, overlooks the diverse needs and circumstances of individuals. This generic application of advice fails to acknowledge that social insurance programs, while broadly beneficial, may not perfectly align with every client's unique situation, potentially leading to misallocation of resources or inadequate coverage. The professional decision-making process for similar situations should involve a structured approach. First, thoroughly understand the client's financial profile and objectives. Second, research and understand the specific social insurance programs relevant to the client's situation, including their benefits, costs, and eligibility. Third, conduct a comparative analysis, highlighting the pros and cons of participation versus non-participation or alternative private solutions. Fourth, clearly communicate these findings to the client, ensuring they understand the implications. And finally, guide the client in making an informed decision that best serves their individual needs and goals. Question 6. Operational review demonstrates that a small manufacturing business, which has experienced steady growth but has limited capital reserves, is seeking to ensure its product liability exposure. The business owner expresses a strong desire to keep initial insurance costs as low as possible while still feeling covered. The advisor needs to recommend appropriate limits of liability. Which of the following approaches best aligns with the principles of responsible insurance advice and regulatory expectations for an accredited advisor in insurance? Option A. Recommend limits of liability that are based on a detailed assessment of the business's specific product types, potential for harm, historical claims data, if any, and the client's financial capacity to absorb deductibles and potential uninsured losses, explaining the rationale for the chosen limits and the implications of higher or lower coverage. Option B. Recommend limits of liability based solely on the average limits typically purchased by similar businesses in the industry, without a detailed analysis of the specific client's operations or financial capacity. Option C. Recommend the absolute highest limits of liability available in the market to ensure maximum protection, regardless of the client's current financial situation or the likelihood of extreme claims. Option D. Recommend the lowest possible limits of liability that meet the minimum statutory requirements, focusing primarily on minimizing the client's immediate premium outlay. Correct answer is A. Recommend limits of liability that are based on a detailed assessment of the business's specific product types, potential for harm, historical claims data, if any, and the client's financial capacity to absorb deductibles and potential uninsured losses, explaining the rationale for the chosen limits and the implications of higher or lower coverage. Explanation. This scenario is professionally challenging because it requires an accredited advisor in insurance to balance the client's immediate desire for comprehensive coverage with the long-term financial prudence and regulatory obligations. The advisor must assess the client's risk appetite, financial capacity, and the potential for catastrophic loss, all while adhering to the principles of responsible insurance advice. The core of the challenge lies in determining appropriate limits of liability that are neither excessively restrictive, leaving the client underinsured, nor unnecessarily high, leading to unaffordable premiums and potential overinsurance. The correct approach involves a thorough risk assessment that quantifies potential losses and considers the client's ability to absorb deductibles and uninsured losses. This approach aligns with the regulatory framework that mandates advisors to act in the best interests of their clients. Specifically, it reflects the duty to provide advice that is suitable and appropriate, considering the client's circumstances and the nature of the risks they face. By recommending limits that reflect a realistic assessment of potential liabilities and the client's financial resilience, the advisor upholds their fiduciary duty and ensures the client receives value for their insurance investment. thereby complying with the spirit and letter of insurance advisory regulations. An incorrect approach that focuses solely on minimizing the client's immediate premium outlay without a commensurate assessment of potential exposure would be professionally unacceptable. This failure stems from a disregard for the client's actual risk profile and could lead to significant financial hardship if a claim exceeds the inadequate coverage. Such an approach violates the principle of providing suitable advice and could expose the advisor to regulatory sanctions for failing to meet their professional obligations. Another incorrect approach that prioritizes the highest possible limits of liability without considering the client's financial capacity or the likelihood of such extreme events would also be professionally unsound. While seemingly offering maximum protection, this can result in unaffordable premiums, making the insurance unsustainable for the client. This can also lead to overinsurance, where the sum insured exceeds the actual value of the asset or potential liability, which is contrary to the principles of sound insurance practice and may be viewed as mis-selling. A further incorrect approach that relies on generic industry standards without tailoring the advice to the specific client's operations and risk profile is also problematic. While industry benchmarks can be a starting point, they do not account for the unique circumstances, risk tolerance, and financial capabilities of an individual client. Failing to individualize the advice can lead to either underinsurance or overinsurance, both of which are detrimental to the client and reflect a lack of due diligence on the part of the advisor. A professional decision-making process for similar situations should involve a structured risk assessment framework. This begins with understanding the client's business, operations, and potential liabilities. It then involves quantifying these risks, considering the client's financial capacity to bear deductibles and uninsured losses, and exploring various coverage options. The advisor must then clearly communicate the rationale behind their recommendation, explaining the trade-offs between premium costs and coverage levels, and ensuring the client makes an informed decision based on a comprehensive understanding of their risk exposure and the proposed insurance solutions. Question 7. The monitoring system demonstrates that an applicant for life insurance has disclosed a pre-existing medical condition in their application. However, the accompanying medical report from their physician contains a brief, somewhat ambiguous statement regarding the severity and current management of this condition. The underwriting team is under pressure to meet quarterly application processing targets. What is the most appropriate underwriting action to take in this situation? Option A. Immediately decline the application due to the potential for a significant health risk, as indicated by the pre-existing condition. Option B. Accept the application at standard rates without further investigation, assuming the applicant has provided sufficient information. Option C. Request further clarification from the applicant and their physician regarding the medical condition and its management before making a final underwriting decision. Option D. Advise the applicant that their application cannot be processed due to the ambiguity in the medical report, and suggest they reapply after obtaining a more detailed report. The correct answer is A. Immediately decline the application due to the potential for a significant health risk, as indicated by the pre-existing condition. Explanation. This scenario presents a professional challenge because it requires the underwriter to balance the need for accurate risk assessment with the ethical obligation to treat all applicants fairly and avoid discriminatory practices. The pressure to meet underwriting targets can create a temptation to overlook or downplay potential red flags, but adherence to regulatory frameworks and ethical principles is paramount. Careful judgment is required to ensure that underwriting decisions are based on objective risk factors and not on subjective biases or assumptions. The correct approach involves a thorough review of all submitted documentation, including the medical report, and seeking clarification from the applicant or their medical practitioner regarding any ambiguities or discrepancies. This demonstrates a commitment to a comprehensive and fair underwriting process, aligning with the regulatory requirement to assess risk accurately and without prejudice. Specifically, the Insurance Act specifies relevant jurisdictions Insurance Act, e.g., the UK's Insurance Act 2015, or relevant US state insurance code, mandates that insurers must assess risk based on relevant factors and not engage in unfair discrimination. Ethical guidelines for insurance professionals, often reinforced by industry bodies like the Chartered Insurance Institute, CI, in the UK, or relevant professional bodies in other jurisdictions, emphasize integrity, objectivity, and fairness in all dealings with clients. An incorrect approach of immediately declining coverage based on a single, potentially misinterpreted medical finding fails to uphold the principle of fair assessment. This could lead to a breach of regulations prohibiting unfair discrimination, as the decision is not based on a complete understanding of the applicant's risk profile. Furthermore, it violates the ethical duty to act in the best interests of the client by prematurely denying them access to necessary insurance coverage without due diligence. Another incorrect approach of accepting the application without further investigation, despite the presence of a potentially significant medical condition, exposes the insurer to adverse selection and financial risk. While seemingly client-friendly in the short term, it undermines the fundamental principle of underwriting, which is to price risk accurately. This can lead to unsustainable premium rates for all policyholders and potentially violate regulatory requirements related to solvency and financial soundness of the insurer. The professional reasoning process for similar situations should involve a structured approach. 1. Identify the core issue. In this case, it's a potential discrepancy in medical information affecting risk assessment. 2. Consult relevant regulations and ethical codes. Understand the specific requirements for underwriting, fair treatment of customers, and non-discrimination. 3. Gather all necessary information. Ensure all documentation is complete and accurate. 4. Seek clarification. If information is ambiguous, proactively seek further details from appropriate sources. 5. Assess risk objectively. Base the underwriting decision solely on the evaluated risk factors. 6. Communicate transparently. Clearly explain the decision and the rationale to the applicant. 7. Document the process. Maintain a clear record of all steps taken and decisions made. Question 8. The audit findings indicate that a manufacturing client has experienced several minor disruptions in their supply chain over the past year, including delays in raw material delivery and temporary shutdowns at a key component supplier. The client's current insurance program does not explicitly address business interruption or contingent business interruption related to their supply chain. As an accredited advisor in insurance, what is the most appropriate course of action to address this identified risk exposure? Option A. Suggest that the client focus on negotiating better terms with their current suppliers to reduce the likelihood of future disruptions. Option B. Advise the client to simply increase their existing property damage insurance limits to cover potential losses from supply chain issues. Option C. Recommend that the client purchase a standard business interruption policy without specifically assessing the nuances of their supply chain vulnerabilities. Option D. Recommend a comprehensive review of the client's supply chain to identify critical dependencies, potential failure points, and the financial impact of disruptions, followed by the development of tailored risk mitigation strategies, including appropriate insurance solutions like contingent business interruption coverage. The correct answer is D. Recommend a comprehensive review of the client's supply chain to identify critical dependencies, potential failure points, and the financial impact of disruptions, followed by the development of tailored risk mitigation strategies, including appropriate insurance solutions like contingent business interruption coverage. Explanation. This scenario is professionally challenging because it requires an accredited advisor in insurance to navigate the complexities of supply chain risk management within the strict confines of regulatory compliance and ethical duty to the client. The advisor must balance the client's immediate operational needs with the long-term financial and reputational implications of supply chain disruptions, all while adhering to the principles of sound risk assessment and advice, as mandated by the regulatory framework governing AAIs. The interconnectedness of modern business means that a failure in one part of the supply chain can have cascading effects, making proactive identification and mitigation of these risks paramount. The correct approach involves a comprehensive assessment of the client's supply chain, identifying critical dependencies, potential points of failure, and the financial impact of disruptions. This includes evaluating the resilience of key suppliers, understanding their own risk mitigation strategies, and considering alternative sourcing options. The advisor must then recommend a tailored risk management strategy that aligns with the client's risk appetite and financial capacity, potentially including insurance solutions, business continuity planning, and supplier diversification. This approach is ethically sound and regulatorily compliant, as it demonstrates a fiduciary duty to act in the client's best interest by providing informed, proactive advice that protects their business from significant financial harm. It aligns with the AAI's responsibility to offer advice that is suitable and effective, based on a thorough understanding of the client's unique circumstances and the risks they face. An incorrect approach that focuses solely on the immediate cost of insurance premiums without a thorough risk assessment fails to uphold the client's best interests. This oversight neglects the potential for significant uninsured losses that could arise from supply chain disruptions, thereby failing to provide adequate protection. Such an approach could be seen as a breach of the advisor's duty of care and potentially a violation of regulatory requirements that mandate a comprehensive understanding of a client's needs and risks before recommending solutions. Another incorrect approach that prioritizes only the most visible or commonly insured risks, such as direct property damage, while ignoring less obvious but potentially more impactful supply chain vulnerabilities, e.g., cyber attacks on logistics partners, geopolitical instability affecting raw material sourcing, is also professionally deficient. This selective risk identification demonstrates a lack of due diligence and an incomplete understanding of the client's overall risk profile. It fails to meet the regulatory expectation of providing holistic advice that addresses all material risks relevant to the client's business operations. A third incorrect approach that relies on generic, off-the-shelf risk management templates without tailoring them to the client's specific industry, operational model, and supply chain structure is equally problematic. This superficial engagement fails to identify unique vulnerabilities and may lead to the implementation of ineffective or insufficient mitigation strategies. It falls short of the professional standard expected of an AAI, which requires a personalized and in-depth analysis to deliver truly valuable advice. A professional decision-making process for similar situations should involve a structured approach. First, thoroughly understanding the client's business and its supply chain dependencies. Second, conducting a detailed risk assessment to identify potential disruptions and their financial impact. Third, evaluating existing risk mitigation measures and insurance coverage. Fourth, developing and presenting a range of appropriate risk management strategies, including insurance and non-insurance solutions. And finally, documenting the advice provided and the client's decision-making process. This systematic process ensures that advice is comprehensive, client-centric, and compliant with all regulatory and ethical obligations. Question 9. Risk assessment procedures indicate that client who has been invested in a diversified portfolio aligned with their long-term retirement goals is experiencing significant anxiety due to recent market volatility and is requesting immediate withdrawal of all funds to preserve capital. As an accredited advisor in insurance, what is the most appropriate course of action? Option A. Recommend a complete shift to ultra-low-risk, fixed-income investments to eliminate market exposure, regardless of the client's original long-term objectives. Option B. Advise the client to immediately liquidate all investments to prevent further capital erosion, as their current anxiety suggests a change in risk tolerance. Option C. Reiterate the importance of the long-term investment strategy and diversification, explaining how market fluctuations are a normal part of investing and advising the client to remain invested according to their plan. Option D. Suggest investing in highly speculative, short-term trading strategies to quickly recover any perceived losses. The correct answer is C. Reiterate the importance of the long-term investment strategy and diversification, explaining how market fluctuations are a normal part of investing and advising the client to remain invested according to their plan. Explanation. Scenario analysis. This scenario is professionally challenging because it requires the accredited advisor in insurance to balance the client's immediate financial needs with the long-term investment principles of diversification and risk management, all within the regulatory framework governing financial advice. The client's emotional response to market volatility can lead to impulsive decisions that contradict sound investment strategy, necessitating a measured and informed approach from the advisor. Correct approach analysis. The correct approach involves educating the client on the importance of maintaining a diversified portfolio and adhering to the long-term investment plan, even during periods of market downturn. This aligns with regulatory requirements for advisors to act in the best interests of their clients and to provide advice that is suitable and appropriate. The principle of diversification, a cornerstone of investment theory and regulatory guidance, aims to mitigate risk by spreading investments across different asset classes, industries, and geographies. Advising the client to stay the course, based on their established risk tolerance and financial goals, upholds the fiduciary duty and promotes prudent investment management, preventing short-term emotional reactions from derailing long-term objectives. Incorrect approaches analysis. Advising the client to immediately liquidate all investments to avoid further losses is an incorrect approach. This action would likely crystallize losses, fail to capture potential market recoveries, and disregard the principle of diversification. It prioritizes short-term emotional relief over long-term financial well-being, and potentially violates the duty to provide suitable advice, as it does not consider the client's overall financial plan or risk tolerance. Suggesting a shift to extremely conservative, low-return investments without a thorough reassessment of the client's long-term goals and risk tolerance is also an incorrect approach. Aiming to reduce risk, such a drastic and potentially premature shift could significantly hinder the client's ability to meet their future financial objectives, such as retirement planning. It may not be in the client's best interest if their long-term needs still require growth-oriented investments. Recommending speculative, high-risk investments to catch up on perceived losses is a highly inappropriate and incorrect approach. This directly contradicts the principles of prudent investment and risk management. It exposes the client to potentially catastrophic losses and is a clear breach of the duty to act in the client's best interests and provide suitable advice. Professional reasoning. Professionals should approach such situations by first acknowledging the client's concerns and emotions. Then, they must refer back to the client's established financial plan, risk tolerance assessment, and investment objectives. The advisor's role is to provide objective, informed guidance based on sound investment principles and regulatory requirements, rather than reacting to market sentiment or client anxiety. This involves clear communication about the rationale behind the investment strategy and the potential consequences of deviating from it. Question 10. The audit findings indicate that an insurance advisor consistently recommends annuity products that offer higher commission rates to the advisor, even when alternative investment vehicles might be more suitable for the client's stated risk tolerance and long-term financial goals. The advisor has not explicitly disclosed the commission structure or the potential conflict of interest to the clients. Which of the following approaches best aligns with the principles and guidelines established by the National Association of Insurance Commissioners, NAIC, for accredited insurance advisors? Option A. Focus solely on the potential tax advantages of annuity products, as these are often a primary driver for client interest, and assume that higher commissions are a standard part of the industry. Option B. Implement a clear and transparent disclosure process for all commission structures and potential conflicts of interest, and ensure that annuity recommendations are demonstrably suitable for the client's individual needs and objectives, prioritizing client best interest. Option C. Continue recommending the higher commission annuities, as long as the products are technically compliant with all regulatory requirements and the advisor believes they offer some benefit to the client. Option D. Immediately cease recommending any annuity products until a comprehensive review of all product commission structures and client suitability assessments can be completed. Correct answer is C. Continue recommending the higher commission annuities, as long as the products are technically compliant with all regulatory requirements and the advisor believes they offer some benefit to the client. Explanation. This scenario is professionally challenging because it requires an insurance professional to navigate potential conflicts of interest and ensure compliance with regulatory standards, specifically those set forth by the National Association of Insurance Commissioners, NAIC. The core of the challenge lies in maintaining objectivity and acting in the best interest of the client, while also adhering to the ethical guidelines and disclosure requirements mandated by the NAIC model laws and regulations that govern insurance sales practices. Careful judgment is required to distinguish between legitimate business practices and those that could be construed as misleading or self-serving. The correct approach involves a thorough understanding of NAIC guidelines concerning disclosure and suitability. This means proactively identifying and disclosing any potential conflicts of interest, such as receiving commissions or incentives that might influence product recommendations. It also necessitates ensuring that the recommended products are genuinely suitable for the client's needs, financial situation, and objectives, irrespective of any personal gain. This aligns with the NAIC emphasis on consumer protection and fair dealing, which underpins the entire regulatory framework for insurance advisors. An incorrect approach would be to prioritize personal financial gain over client suitability. For instance, recommending a product solely because it offers a higher commission, without a genuine assessment of its appropriateness for the client, violates the ethical principles of fair dealing and the spirit of NAIC regulations designed to prevent predatory sales practices. Another incorrect approach would be to fail to disclose material information about the product or any incentives received. This lack of transparency misleads the client and erodes trust, directly contravening NAIC mandates for clear and honest communication. Finally, ignoring the client's stated needs and recommending a product that does not align with their financial goals, even if it appears beneficial on the surface, demonstrates a failure to uphold the duty of care and suitability expected of an insurance professional under NAIC guidelines. Professionals should employ a decision-making framework that begins with a clear understanding of client needs and objectives. This should be followed by a comprehensive product evaluation based on suitability, not just commission potential. Any potential conflicts of interest must be identified and disclosed transparently. Finally, adherence to all applicable NAIC model laws and state-specific regulations should be a constant consideration throughout the advisory process. Question 11. The audit findings indicate that a client, a small construction company, has been advised to obtain a fidelity bond to guarantee their performance on a new municipal infrastructure project. The AAI who provided this advice did not differentiate between the types of surety bonds available, based on the principles of surety bonds and regulatory expectations for accredited advisors in insurance. Which of the following best describes the appropriate course of action for the AAI? Option A. Reassure the client that a fidelity bond is a general surety product that can be adapted for various business guarantees, including project performance. Option B. Explain to the client that a fidelity bond is designed to protect employers against employee dishonesty and is therefore irrelevant to a construction project performance guarantee. Option C. Advise the client that a contract bond is the appropriate instrument to guarantee performance on a construction project, as it protects the obligee against the principal's failure to complete the work as per the contract. Option D. Recommend that the client obtain a license and permit bond, as this type of bond is commonly used for all types of business operations requiring external guarantees. The correct answer is C. Advise the client that a contract bond is the appropriate instrument to guarantee performance on a construction project, as it protects the obligee against the principal's failure to complete the work as per the contract. Explanation. This scenario is professionally challenging because it requires the accredited advisor in insurance to navigate the complexities of surety bonds, specifically distinguishing between contract, license, and permit, and fidelity bonds, while also adhering to the regulatory framework governing their professional conduct. The audit findings highlight a potential lapse in understanding or application of these different bond types, which could lead to misadvising clients, incorrect product placement, and ultimately, regulatory scrutiny or financial loss for the client. The AAI must demonstrate a thorough understanding of the purpose, obligee, principal, and surety's obligations for each bond type to provide accurate and compliant advice. The correct approach involves accurately identifying the nature of the underlying obligation and matching it with the appropriate surety bond type. This means recognizing that a contract bond guarantees performance of a construction or service agreement. A license and permit bond guarantees compliance with regulatory requirements for a business or individual to operate, and a fidelity bond protects an employer against financial loss due to dishonest acts of its employees. By correctly categorizing the client's need and recommending the suitable bond, the AAI ensures compliance with the spirit and letter of surety bond principles and regulatory expectations for professional advice. This aligns with the AAI's duty to act in the client's best interest and to provide advice that is technically sound and legally compliant. An incorrect approach would be to broadly categorize all these as surety bonds, without differentiating their specific functions and regulatory underpinnings. This demonstrates a superficial understanding and could lead to recommending a fidelity bond for a situation requiring a contract bond. For example, such a misclassification would fail to meet the client's actual need, potentially leaving them exposed to significant financial risk and violating the AAI's obligation to provide competent advice. Another incorrect approach would be to assume that all business-related guarantees fall under a single type of surety product, ignoring the distinct legal and contractual frameworks that govern contract, license and permit, and fidelity bonds. This oversight could result in the client obtaining a bond that offers no protection for the specific risk they are trying to mitigate, leading to a breach of professional duty. The professional decision-making process for similar situations should begin with a thorough needs assessment of the client's situation. This involves asking clarifying questions to understand the exact nature of the obligation the client needs to guarantee or protect against. Following this, the AAI must draw upon their knowledge of different surety bond types, understanding their distinct purposes, obligors, obligees, and the specific risks they cover. The next step is to match the client's identified need with the most appropriate surety bond product, ensuring that the recommendation is not only suitable, but also compliant with all relevant regulations and ethical standards. Finally, clear communication with the client about the chosen bond's coverage, limitations, and purpose is essential. Question 12. The control framework reveals a significant network security incident has compromised client data. As an accredited advisor in insurance, what is the most appropriate immediate course of action to uphold regulatory obligations and client trust? Option A. Immediately restore all affected systems to full operational capacity to minimize business disruption, and then investigate the breach. Option B. Engage external cybersecurity consultants to assess the damage and recommend solutions before taking any internal action or notifying regulators. Option C. Initiate a thorough forensic investigation to determine the scope and nature of the breach, isolate affected systems, and prepare for mandatory regulatory notifications. Option D. Focus on communicating with clients about the potential impact of the breach, while deferring the technical investigation until after-service restoration. The correct answer is A. Immediately restore all affected systems to full operational capacity to minimize business disruption, and then investigate the breach. Explanation. Scenario analysis. This scenario is professionally challenging because it requires an accredited advisor in insurance to balance the immediate need for operational continuity with the long-term imperative of robust data security and compliance. The pressure to restore services quickly can lead to shortcuts that compromise regulatory adherence and client trust. The AAI must exercise sound judgment to ensure that the response not only addresses the immediate incident, but also strengthens the firm's overall network security posture in line with regulatory expectations. Correct approach analysis. The correct approach involves a comprehensive incident response plan that prioritizes data integrity and regulatory notification. This means immediately isolating affected systems to prevent further compromise, conducting a thorough forensic investigation to understand the scope and nature of the breach, and promptly notifying all relevant regulatory bodies and affected parties as mandated by law. This approach aligns with the principles of data protection and consumer safeguarding, ensuring transparency and accountability, which are cornerstones of regulatory compliance for financial services professionals. Incorrect approach is analysis. An approach that focuses solely on restoring services without a proper investigation risks reintroducing vulnerabilities or failing to identify the full extent of data exfiltration, leading to potential ongoing harm to clients and regulatory penalties for non-compliance with breach notification requirements. An approach that delays regulatory notification while attempting to manage the situation internally without acknowledging the mandatory reporting timelines constitutes a direct violation of regulatory obligations and can result in significant fines and reputational damage. An approach that involves only a superficial assessment of the breach and a quick fix without a root cause analysis or subsequent security enhancements fails to address systemic weaknesses, leaving the firm exposed to future attacks and demonstrating a lack of due diligence in protecting client data, which is a breach of professional duty. Professional reasoning. Professionals should adopt a structured incident response framework. This involves 1. Preparation, having a well-defined incident response plan in place before an event occurs. 2. Identification, promptly detecting and confirming a security incident. 3. Containment, limiting the damage and preventing further spread. 4. Eradication, removing the cause of the incident. 5. Recovery, restoring systems to normal operation. 6. Lessons learned, analyzing the incident to improve future preparedness and security measures. Crucially, this process must be integrated with clear protocols for regulatory notification and client communication, ensuring all legal and ethical obligations are met at each stage. Question 13. The efficiency study reveals that a significant number of claims involving water damage are experiencing delays in settlement due to disputes over the extent of consequential damage. In one particular case, a policyholder reported a burst pipe causing water damage to a living room floor and adjacent kitchen cabinets. The insurer's initial assessment focused on the visible damage to the floor, but the policyholder claims the moisture has seeped into the cabinet substructure, which is not immediately apparent. The AAI assigned to this claim is aware that the policy covers direct physical loss or damage. What is the most appropriate course of action for the AAI to ensure a fair and compliant loss settlement? Option A. Recommend a settlement that includes a reasonable allowance for potential substructure damage, contingent on further professional assessment by a qualified contractor, and clearly communicate the policy's coverage for direct physical loss. Option B. Delay the settlement offer until the policyholder provides irrefutable proof of substructure damage, which may require extensive and costly independent testing. Option C. Advise the policyholder that coverage is limited to visible damage only and that any claims for hidden damage are excluded under the policy. Option D. Offer a settlement based solely on the visible damage to the living room floor, as this is the only directly observable loss at this stage. The correct answer is D. Offer a settlement based solely on the visible damage to the living room floor, as this is the only directly observable loss at this stage. Explanation. This scenario presents a professional challenge because it requires the accredited advisor in insurance to balance the insurer's need for accurate loss assessment with the policyholder's right to a fair and timely settlement, all while adhering to specific regulatory requirements. The challenge lies in interpreting the policy terms and applying them correctly to a situation where the extent of the loss is not immediately obvious and may involve subjective elements. Careful judgment is required to ensure that the settlement reflects the actual loss sustained without undue delay or imposition of unreasonable conditions. The correct approach involves a thorough investigation of the loss, a clear communication of the policy terms related to settlement, and a commitment to resolving the claim in accordance with those terms and applicable regulations. This approach is right because it prioritizes fairness and compliance. Specifically, it aligns with the regulatory framework's emphasis on prompt and equitable claim handling. The advisor must ensure that the settlement offered is based on a reasonable assessment of the damage and that all policy conditions precedent to settlement have been met. This includes providing the policyholder with clear explanations of how the settlement amount was determined and what their rights are. An incorrect approach would be to offer a settlement based on a superficial assessment without fully investigating the extent of the damage. This fails to meet the regulatory requirement for a thorough and fair investigation, potentially leading to an underpayment and a breach of the duty of good faith owed to the policyholder. Another incorrect approach would be to unduly delay the settlement process by making excessive or unreasonable requests for documentation or information that is not directly relevant to assessing the loss. This can be seen as a tactic to avoid or minimize payment, and is contrary to the spirit and letter of regulations promoting timely claim resolution. Furthermore, attempting to settle the claim for an amount significantly below the actual loss, based on a misinterpretation or selective application of policy wording, constitutes a failure to act in good faith and in accordance with the policy contract. Professionals should approach such situations by first understanding the specific policy provisions related to loss settlement. They must then conduct a diligent investigation, gathering all necessary evidence to accurately assess the loss. Throughout this process, open and honest communication with the policyholder is paramount. If there are ambiguities in the policy or the loss assessment, the advisor should seek clarification from the insurer and provide the policyholder with a clear explanation of the insurer's position and the basis for the settlement offer. The decision-making process should be guided by the principles of fairness, transparency, and adherence to regulatory requirements for claim settlement. Question 14. What factors determine the suitability of an investment for a client within the context of an insurance product, from the perspective of an accredited advisor in insurance operating under the relevant regulatory framework? Option A. The potential for the highest possible returns, regardless of the client's risk profile or regulatory limitations. Option B, the advisor's personal familiarity with a particular investment product and its perceived ease of sale. Option C, the client's stated financial objectives, risk tolerance, time horizon, and the specific regulatory requirements for investments within insurance products. Option D, the prevailing market sentiment and the general popularity of certain asset classes at the time of recommendation. The correct answer is C. The client's stated financial objectives, risk tolerance, time horizon, and the specific regulatory requirements for investments within insurance products. Explanation: this scenario is professionally challenging because an accredited advisor in insurance, I, must balance the client's immediate financial needs with the long-term implications of investment choices, all while adhering to strict regulatory obligations. The core challenge lies in interpreting client objectives and risk tolerance accurately, and translating them into suitable investment strategies within the prescribed regulatory framework. The correct approach involves a comprehensive assessment of the client's financial situation, investment objectives, and risk tolerance, followed by the selection of investment products that align with these factors and are compliant with relevant insurance regulations. This approach is correct because it prioritizes the client's best interests, a fundamental ethical and regulatory requirement for financial advisors. Specifically, regulations governing financial advice, such as those pertaining to suitability and fiduciary duty, where applicable, mandate that advisors act in the client's best interest. This involves understanding the client's circumstances, including their capacity for risk, their need for liquidity, and their overall financial goals, before recommending any investment. The advisor must also ensure that any recommended investment is appropriate for the client, and that all associated risks are clearly communicated. An incorrect approach would be to focus solely on the potential for high returns, without adequately considering the client's risk tolerance or the regulatory suitability of the investment for an insurance-linked product. This fails to meet the regulatory requirement of ensuring investments are appropriate for the client's circumstances, and could lead to significant client detriment if the investment underperforms or is too volatile for their risk profile. Another incorrect approach would be to recommend investments based on personal preference or commission potential, rather than objective analysis of the client's needs and the investment's suitability. This violates ethical principles of impartiality and could contravene regulations prohibiting conflicts of interest or mis-selling. A further incorrect approach would be to overlook the specific regulatory constraints and reporting requirements associated with insurance-linked investments. For instance, certain investments might have restrictions on their use within insurance products or require specific disclosures that, if ignored, lead to regulatory noncompliance and potential penalties. The professional decision-making process for similar situations should involve a structured approach. 1. Thorough client fact-finding. Conduct detailed interviews to understand the client's financial situation, objectives, time horizon, and risk tolerance. 2. Regulatory compliance check. Identify all applicable regulations governing the proposed investment and the client's specific situation. 3. Investment analysis. Evaluate potential investments based on their risk-return profile, liquidity, diversification, and suitability for the client's stated needs and risk tolerance. 4. Recommendation and disclosure. Formulate a recommendation that clearly aligns with the client's profile and regulatory requirements, providing comprehensive disclosure of all associated risks, costs, and benefits. 5. Ongoing monitoring. Regularly review the investment performance and the client's circumstances to ensure continued suitability. Question 15. Examination of the data shows that a commercial client, operating a manufacturing facility, has identified several large, custom-built machinery units that are bolted to the floor for stability. The client considers these units to be personal property because they are essential for their specific manufacturing process and could theoretically be moved if the business relocated, although doing so would be extremely costly and complex. The insurance policy in question defines building to include fixtures and fittings attached to the building, and personal property to include contents of a movable nature not permanently attached to the building. The accredited advisor in insurance, I, must determine how these machinery units should be classified for insurance purposes. Which of the following approaches best addresses this implementation challenge? Option A. Classify the machinery units as building fixtures, as their significant attachment to the building for operational stability and the substantial cost and complexity of relocation suggest they are integral to the facility's function, and advise the client on the implications for building coverage. Option B. Classify the machinery units as personal property based on the client's assertion of movability and recommend a separate, specialized equipment floater policy to cover these high-value items, irrespective of their attachment to the building. Option C. Classify the machinery units as personal property, as the client has stated they are movable and essential for their specific manufacturing process, and ensure they are adequately covered under the personal property section of the policy. Option D. Advise the client that the classification is ambiguous and recommend they obtain a legal opinion to definitively determine whether the machinery units are building fixtures or personal property before proceeding with policy placement. The correct answer is C. Classify the machinery units as personal property, as the client has stated they are movable and essential for their specific manufacturing process, and ensure they are adequately covered under the personal property section of the policy. Explanation. This scenario presents a professional challenge because it requires the accredited advisor in insurance to navigate the complexities of defining covered property for a commercial client, specifically distinguishing between building elements and personal property, which has direct implications for policy coverage and potential claims. The challenge lies in accurately interpreting policy wording against the physical reality of the insured premises and the client's business operations, ensuring adequate protection without overinsuring or underinsuring. Careful judgment is required to avoid misclassification that could lead to coverage disputes or financial loss for the client. The correct approach involves a thorough review of the insurance policy's definitions of building and personal property, and a physical inspection of the insured premises to assess how these definitions apply to the specific items in question. This approach ensures that the advisor is aligning the policy's intent with the client's actual property. For example, if the policy defines building to include fixtures permanently attached, and the advisor identifies such fixtures that the client considers personal property, the advisor must clarify this distinction with the client and potentially recommend endorsements or adjustments to ensure accurate coverage. This aligns with the AAI's ethical duty to act in the client's best interest and to provide advice that is clear, accurate, and based on a sound understanding of the policy and the client's circumstances, adhering to principles of utmost good faith and professional competence. An incorrect approach would be to solely rely on the client's verbal assertion that an item is personal property without verifying its nature and attachment to the building against the policy's definitions. This failure to independently assess and verify could lead to misclassification, potentially leaving a critical component of the business's operational assets uninsured under the building section, or conversely, insuring items that should be covered under a separate personal property policy. This violates the professional obligation to provide accurate advice and can result in significant financial detriment to the client during a claim. Another incorrect approach is to assume that all items within the insured premises are automatically covered under either the building or personal property sections, without a detailed review of the policy's specific exclusions and definitions. For instance, certain types of equipment or stock might have specific coverage limitations or require separate endorsements, and a failure to identify these could lead to gaps in coverage. This demonstrates a lack of due diligence and a failure to fully understand the scope of the policy being recommended or managed. A further incorrect approach is to apply a generic understanding of building and personal property without considering the specific wording of the insurance contract. Insurance policies are contracts with precise definitions, and deviating from these definitions based on common understanding can lead to incorrect advice. This disregard for contractual specificity is a failure of professional responsibility. The professional decision-making process for similar situations should involve a systematic approach. First, thoroughly understanding the client's business and assets. Second, meticulously reviewing the relevant policy wording, paying close attention to definitions, exclusions, and conditions. Third, conducting a physical inspection or requesting detailed information about the property to be insured. Fourth, clearly communicating the implications of policy definitions to the client, especially where ambiguity or potential for misclassification exists. And finally, documenting all advice and decisions to ensure transparency and accountability. Question 16. When evaluating a client's insurance portfolio, how should an accredited advisor in insurance best explain the relationship between a commercial general liability policy and an umbrella liability policy in the context of a significant claim that may exceed the primary policy's limits. Option A. Advise the client that the umbrella liability policy offers separate and independent coverage for all liability claims, regardless of the commercial general liability policy's status. Option B. Explain that the umbrella liability policy provides an additional layer of coverage that is triggered only after the limits of the commercial general liability policy have been exhausted by the payment of claims. Option C. Suggest that the umbrella liability policy is primarily for catastrophic events and may not respond to claims that are only slightly above the primary policy's limits. Option D. Inform the client that the total aggregate limit of both policies combined is the primary figure to consider, without detailing the sequential activation of coverage. The correct answer is B. Explain that the umbrella liability policy provides an additional layer of coverage that is triggered only after the limits of the commercial general liability policy have been exhausted by the payment of claims. Explanation: this scenario is professionally challenging because it requires an accredited advisor in insurance to differentiate between the primary coverage provided by a commercial general liability policy and the excess coverage offered by an umbrella liability policy, specifically in the context of a complex claim that potentially exhausts the primary policy limits. The advisor must accurately explain the distinct roles and triggers for each policy to a client, ensuring the client understands their total protection. This requires a deep understanding of policy wordings and the regulatory expectations for clear and accurate advice. The correct approach involves clearly articulating that the umbrella liability policy acts as an excess layer of coverage, providing additional limits above the primary commercial general liability policy. This approach correctly emphasizes that the umbrella policy's coverage is triggered only after the underlying primary policy has been exhausted by paying claims. This aligns with regulatory expectations for advisors to provide clear, accurate, and comprehensive advice regarding policy coverage and limitations, preventing misrepresentation and ensuring clients make informed decisions about their risk management strategies. An incorrect approach that suggests the umbrella policy provides standalone coverage for all liability claims, irrespective of the primary policy's limits, is fundamentally flawed. This fails to acknowledge the excess nature of umbrella coverage and misrepresents the policy's function, potentially leading the client to believe they have broader coverage than they actually do. This constitutes a failure to provide accurate advice and could be seen as a misrepresentation of policy terms, violating ethical obligations and potentially regulatory requirements for fair dealing. Another incorrect approach that focuses solely on the total aggregate limit of both policies without explaining the sequential trigger mechanism is also problematic. While the total limit is a relevant figure, failing to explain how it's accessed, i.e., the primary policy must be depleted, first leaves the client with an incomplete understanding of their coverage. This lack of clarity can lead to surprises when a claim occurs and the primary policy limits are reached, but the client is unaware that the umbrella coverage is now active. This falls short of the professional standard for providing thorough and understandable advice. The professional decision-making process for similar situations should involve a systematic review of the client's existing policies, a thorough understanding of the interplay between primary and excess coverage, and a commitment to communicating this information in a clear, concise, and client-friendly manner. Advisors should always prioritize accuracy and completeness, ensuring clients fully grasp the scope and limitations of their insurance protection. Question 17. Stakeholder feedback indicates a recurring concern among clients regarding their understanding of policy coverage, particularly when comparing policies that list specific covered perils versus those that cover all perils not specifically excluded. As an accredited advisor in insurance, how should you best address this client education gap to ensure they make informed decisions about their insurance protection? Option A. State that all risk policies cover virtually everything, and clients typically understand the implications of exclusions. Option B. Explain that all risk policies cover everything unless it's explicitly stated as an exclusion, while named peril policies only cover the specific risks listed. Option C. Briefly mention that all risk policies offer broader protection than named peril policies without delving into the specifics of exclusions. Option D. Focus on the policy's premium cost as the primary differentiator, implying that higher premiums for all risk policies inherently mean comprehensive coverage? Correct answer is B. Explain that all risk policies cover everything unless it's explicitly stated as an exclusion, while named peril policies only cover the specific risks listed. Explanation. This scenario is professionally challenging because it requires the accredited advisor in insurance to balance client needs with regulatory compliance when explaining policy coverage. The distinction between named peril and all-risk policies is fundamental to client understanding and appropriate risk management. Misrepresenting or oversimplifying this distinction can lead to significant client dissatisfaction, potential E&O claims, and regulatory scrutiny. The advisor must ensure the client fully comprehends the scope of coverage and any limitations. The correct approach involves clearly articulating the difference between named peril and all-risk policies, emphasizing that named peril policies only cover specific listed causes of loss, while all-risk policies cover all causes of loss unless specifically excluded. This approach aligns with the regulatory requirement for advisors to act in the client's best interest and to provide clear, accurate information. Ethical obligations mandate transparency and a thorough explanation of policy terms to enable informed decision-making. This ensures the client selects coverage that genuinely meets their risk profile and expectations, thereby fulfilling the advisor's duty of care. An incorrect approach that focuses solely on the broader all-risk terminology without detailing exclusions fails to meet the regulatory standard of providing complete and accurate information. This can mislead the client into believing they have more comprehensive coverage than they actually do, potentially leaving them exposed to uninsured losses. Ethically, this omission constitutes a failure to disclose material information. Another incorrect approach that prioritizes expediency by simply stating it covers everything without qualification is equally problematic. This is a gross oversimplification that ignores the critical role of exclusions in all risk policies. Regulatory frameworks require advisors to explain policy limitations, not just its broad coverage. This approach violates the duty to provide accurate and complete advice, potentially leading to a breach of contract or misrepresentation claims. A further incorrect approach that assumes the client understands the nuances of peril coverage without explicit explanation is also unacceptable. Advisors have a professional responsibility to educate their clients and ensure comprehension, especially on critical policy distinctions. Relying on client assumptions rather than proactive explanation is a failure in professional duty and can lead to regulatory noncompliance and ethical breaches. The professional decision-making process for similar situations should involve a structured approach. 1. Identify the core issue. The client needs to understand the difference between named peril and all-risk coverage. 2. Consult relevant regulations. Review the specific requirements for disclosure and advice under the applicable insurance regulatory framework. 3. Prioritize client understanding. Frame the explanation in clear, accessible language, avoiding jargon where possible. 4. Detail policy specifics. Explain the concept of named perils and the broad coverage with specific exclusions for all risk policies. 5. Confirm comprehension. Actively seek client confirmation that they understand the coverage and its limitations. 6. Document advice. Maintain records of the advice provided and the client's understanding. Question 18. System analysis indicates that an accredited advisor in insurance is reviewing their customer relationship management (CRM) system's functionality. The primary objective is to enhance client engagement and identify cross-selling opportunities. The advisor is considering two potential enhancements. 1. Implementing an automated system that analyzes client purchase history and demographic data to proactively suggest new insurance products via email, without explicit prior consent for this specific type of marketing communication. 2. Upgrading the CRM to include a secure client portal where clients can view their policy details, update personal information, and manage their communication preferences, including opting in or out of targeted product recommendations. Which of the following approaches best aligns with the regulatory framework and ethical obligations for an AAI in managing client relationships and data? Option A. Prioritize the automated product suggestion system to maximize sales and client outreach. Option B. Focus solely on collecting more demographic data to refine future marketing campaigns. Option C. Integrate both systems immediately to capture all potential client data and sales opportunities. Option D. Implement the secure client portal with robust data management and communication preference controls. The correct answer is A. Prioritize the automated product suggestion system to maximize sales and client outreach. Explanation. This scenario presents a professional challenge due to the inherent tension between leveraging customer data for personalized service and maintaining client confidentiality and data privacy, as mandated by regulatory frameworks governing insurance advice. The accredited advisor in insurance, I, must navigate this by ensuring all CRM activities strictly adhere to the principles of informed consent, data security, and transparency. The correct approach involves a CRM system that prioritizes client consent for data usage, implements robust security measures to protect sensitive information, and provides clear communication channels for clients to manage their data preferences. This aligns with the regulatory expectation that advisors act in the best interests of their clients, which includes safeguarding their personal and financial information. Specifically, it upholds the principles of data protection and client confidentiality, ensuring that any use of CRM data for marketing or service enhancement is explicitly authorized by the client and conducted in a manner that respects their privacy. An incorrect approach that focuses solely on maximizing sales opportunities through aggressive data mining without explicit client consent would violate data protection regulations and ethical obligations. This failure stems from a disregard for client privacy and a potential breach of trust, leading to regulatory penalties and reputational damage. Another incorrect approach, which involves storing client data in an insecure manner or failing to implement adequate access controls, exposes sensitive information to unauthorized access, constituting a significant data breach and a violation of the duty of care owed to clients. This also carries severe regulatory consequences. Finally, an approach that fails to provide clients with clear information about how their data is used or how they can opt out of certain communications would be ethically unsound and likely non-compliant with transparency requirements. Professionals should employ a decision-making framework that begins with understanding the specific regulatory requirements for data handling and client consent within their jurisdiction. This should be followed by an assessment of the ethical implications of any proposed CRM strategy, prioritizing client trust and data security. Implementing a CRM system should involve a thorough risk assessment, ensuring that all data processing activities are transparent, consensual, and secure, with regular reviews to ensure ongoing compliance and ethical practice. Question 19. Regulatory review indicates that an accredited advisor in insurance, I, is advising a client on purchasing a new life insurance policy. The AAI is personally a policyholder in a prominent mutual life insurance company and believes this type of insurer generally offers competitive dividends to policyholders. The client has expressed a desire for long-term financial security and a stable product. The AAI must recommend an insurer type, which approach best upholds the AAI's professional and regulatory obligations. Option A. Prioritize recommending a stock life insurance company due to potentially higher commission structures, which the AAI believes will provide better overall service to the client. Option B. Recommend a mutual life insurance company, highlighting the potential for dividends as a benefit for long-term policyholders. Without extensively exploring other insurer types, Option C. Conduct a thorough needs analysis of the client's financial security goals and risk tolerance, then recommend the insurer type, stock, mutual, or reciprocal, that best aligns with these specific client needs, regardless of the AAI's personal holdings. Option D. Suggest a reciprocal insurer, as the AAI has a general understanding that they are member-owned and might offer unique benefits, without detailed investigation into the client's specific suitability. The correct answer is B. Recommend a mutual life insurance company, highlighting the potential for dividends as a benefit for long-term policyholders, without extensively exploring other insurer types. Explanation. This scenario presents a professional challenge because it requires an accredited advisor in insurance, I, to navigate a conflict of interest arising from their dual role as an advisor and a potential beneficiary of a specific insurer's structure. The AAI must prioritize their clients' best interests above any personal or structural advantage they might perceive from a particular insurer type. The core ethical and regulatory imperative is to provide unbiased advice that aligns with the client's needs and objectives, irrespective of the insurer's ownership structure. The correct approach involves thoroughly assessing the client's specific insurance needs, risk tolerance, and financial goals, and then recommending the insurer type, stock, mutual, or reciprocal, that best serves these individual client requirements. This approach is ethically sound and regulatorily compliant because it upholds the fiduciary duty owed to the client. The AAI's primary obligation is to act in the client's best interest, ensuring that the chosen insurer structure offers the most suitable coverage, terms, and potential benefits, like dividends in a mutual insurer, if applicable and relevant to the client's situation, without being influenced by the AAI's potential personal gain or affiliation. This aligns with the principles of professional conduct that demand transparency and client-centric advice. An incorrect approach would be to steer the client towards a mutual insurer solely because the AAI is a policyholder of that insurer and might benefit from its performance through dividends, without a thorough needs analysis. This constitutes a conflict of interest and a failure to act in the client's best interest, potentially violating regulatory requirements for unbiased advice and client suitability. Another incorrect approach would be to favor a stock insurer because it offers higher commission potential for the AAI, again disregarding the client's specific needs and the suitability of the insurer type. This prioritizes the AAI's financial gain over the client's welfare, a clear ethical breach. Recommending a reciprocal insurer without a comprehensive understanding of its specific operational model and how it aligns with the client's risk profile and long-term objectives would also be an incorrect approach, as it suggests a lack of due diligence and a failure to provide tailored advice. The professional decision-making process for similar situations should involve a structured approach. First, identify and disclose any potential conflicts of interest. Second, conduct a comprehensive client needs assessment. Third, evaluate all relevant insurer types, stock, mutual, reciprocal, based on their suitability for the client's identified needs, considering factors like coverage, cost, financial stability, and potential benefits. Fourth, recommend the most appropriate insurer type and specific product, clearly explaining the rationale to the client. Finally, document the entire process, including the client's decision and the reasons for the recommendation. Question 20. The audit findings indicate that a client's insurance policy was deemed invalid due to a dispute over the formation of the contract. The advisor had provided the client with a brochure outlining general coverage options and discussed potential benefits. The client, excited by the prospect of coverage, immediately paid the initial premium. The insurer later denied the claim, stating that no valid contract was ever established. Based on the regulatory framework governing insurance advisors, which of the following best describes the critical element that was likely missing or misunderstood in establishing a binding insurance contract in this scenario? Option A. The client's excitement about potential coverage and the payment of the initial premium were the sole determinants of contract formation, regardless of formal insurer acceptance. Option B. The client's initial expression of interest and subsequent payment of the premium were sufficient to constitute a binding offer and acceptance. Option C. The insurance advisor's verbal assurances about coverage benefits constituted the primary offer, which the client accepted by paying the premium. Option D. The insurer's policy document and the applicant's signed application, along with the premium payment, collectively represent the offer and acceptance, forming a binding contract once all terms are met. The correct answer is D. The insurer's policy document and the applicant's signed application, along with the premium payment, collectively represent the offer and acceptance, forming a binding contract once all terms are met. Explanation. The audit findings indicate a potential lapse in understanding the fundamental elements of an insurance contract, specifically concerning the validity of an offer. This scenario is professionally challenging because an insurance advisor's primary responsibility is to ensure that all contractual agreements entered into by clients are legally sound and enforceable. Misinterpreting or overlooking essential contractual elements can lead to significant financial and legal repercussions for both the client and the insurance company, and can damage the advisor's professional reputation and license. The correct approach involves recognizing that an offer in contract law, including insurance, must be clear, definite, and communicated to the offeree. In this context, the insurer's policy document, coupled with the application form and the premium payment, collectively constitute the offer. The applicant's signature on the application, signifying their intent to accept the terms presented by the insurer, and the subsequent payment of the premium are crucial steps in forming a binding agreement. The regulatory framework for insurance advisors mandates adherence to principles of good faith and due diligence, ensuring that all parties understand their obligations and rights, which is achieved by correctly identifying the offer and its acceptance. An incorrect approach would be to consider the applicant's initial inquiry or expression of interest as the definitive offer. This fails to acknowledge that an offer must be a firm proposal with specific terms and conditions that can be accepted. The regulatory framework emphasizes that a mere expression of interest or a request for information does not create a binding obligation. Another incorrect approach would be to assume that the contract is formed solely upon the payment of the premium, without considering the insurer's acceptance of the application and the clear terms of the policy. This overlooks the requirement for mutual assent and the specific steps outlined in the underwriting and acceptance process. Finally, treating the agent's verbal assurance as the offer, independent of the formal application and policy terms, is also incorrect. Insurance contracts are typically governed by written documentation, and verbal assurances, while potentially persuasive, do not constitute a legally binding offer in the absence of formal acceptance and adherence to policy terms. This violates the principle of clear and documented contractual intent. Professional decision-making in such situations requires a systematic review of the contractual elements. Advisors must verify that a clear offer has been made by the insurer, that the applicant has unequivocally accepted this offer through their actions, e.g., signing the application, paying the premium, that there has been valid consideration, the premium for the promise of coverage, that both parties are legally competent to enter into the contract, and that the purpose of the contract is legal. This structured approach ensures compliance with regulatory requirements and upholds ethical standards.